I'm Evan, StockMarketNewz, the person running the account, so that I'm not going to speak from there. I do just want to preface this a little bit with the purpose of this space. There's a lot of spaces on Twitter and on FinTwit and everything. Obviously, they're on Twitter, on FinTwit about trading and crypto and everything like that right now, but it felt like there was a void for long-term investors. The average person out there probably is a long-term investor. Maybe FinTwit is a little bit different, but there is still a really, really strong community that, we thought we would be able to help with these spaces and really get information out. For a long time, we've been doing deep dives into companies, kind of using that as a way to be as educational as possible. Not necessarily, oh, here's a company, go out and buy it, but here's a company that I did my due diligence into. Here's what I looked for. Here's the numbers. Here's the terms I'm searching for. Here's the type of things I like in a company. So that's what we're really looking for, trying to be as educational as possible. We've kind of branched away into really whatever we can do to be educational, whether it's going through an earnings report, talking about how investors can capitalize on volatility or positioning sizing or whatever. Our goal with this space is really to make it relevant to talk about long-term investing every single week, every single Thursday at noon. Stock Talk Weekly should be in here in a little bit. We're joined by Brad every single week, and we're really lucky to be able to have Richard come in as a guest this week and share us some really, really fantastic information, which I'm very excited for, and I know all of you guys will get some really fantastic value from. So quickly, before we get into it and before I throw it over to Richard and let us hear what he has to say, I do just want to make sure everyone up here, as the people speak, make sure you are checking them out, giving them a follow. The information we're going to get up here is really, really top class. We only brought some of the best long-term investors up here to share information with all of you. So just as they're speaking right now, whatever, make sure you're clicking into their profiles, giving them a follow, checking them out, liking their post, doing whatever you got to do. But we're about to be getting some really great information in here, and the stuff they post is going to be just that much better. So check out everybody. But with that, I would love to throw it over to Richard, a little bit of word jumble there, and kind of get your thoughts on anything you wanted to talk about. If there was a company you wanted to do a deep dive in, any reportings, or any just long-term investing concepts you really wanted to talk about.
Yeah, thanks. So, I post my portfolio every quarter, and some of my talks I've talked about in depth on Twitter, go to Rags and stuff. So I think today's session, I'm going to talk more about kind of my idea of long-term investing. So, I feel that long-term investor is something that everyone says they are, but I think it's actually pretty rare. If you look at the average holding period for US stocks, it's around 5.5 months. Compared to around 7 years back in 1940s. So I think, with the market these days, a lot of it is just driven by flows, algorithms. You see in the media, there's constant noise. Everyone's either telling you to sell or telling you to buy based off of headlines. And you can check the prices of your stock every second on your brokerage app. So there are very low barriers to trade than ever before. And I think, if I were to buy a basket of long-term stocks, it's a great idea to just say I'm going to hold and go to the beach for 10 years. But would I really do that much better if I did not touch it, right? So I think, over the long term, very few things matter. So a few underwhelming quarters for a company is not usually going to change my thesis. Sometimes there's going to be new competitive announcements, like Mark Cuban just announced this cost plus pharmacy. So those stuff, they shouldn't change my thesis, right? Because I should have considered, a company's moat, and that usually doesn't, a moat doesn't usually break in a quarter or two. Some short-term macro headwinds, like the Fed raising interest rates, et cetera, those should all be expected when you're prepared to invest in a company for 5 to 10 years. It's also inevitable that your investment is going to be down, 50% and more from previous all-time highs, probably multiple times over that same period. And what really separates successful investors is not only in their ability to ride out that volatility, but to understand their investment well enough to separate opportunity from trap. And I think that's really important because 2020 was obviously an anomaly, but I think, over the long term, very few stocks actually go up. Most stocks actually go down. So I think there was this white paper by JP Morgan that revealed 40% of the companies in the Russell 3000. So that index tracks around 97% of all US companies. So 40% of those actually suffered a catastrophic stock price loss. So what this means was they went down 70% from all-time highs and they never recovered. So that was 40% of all the companies. And around 2/3 of the time, if you concentrated in a single stock, you would have underperformed the stock market. So clearly, it's quite hard to predict where a company is going to be in 5 to 10 years. If you look at, Amazon, for example, like people like to use the example that back in 2000, it went down like over 90%. And now it's obviously one of the most powerful companies in the world. I think Bezos recently tweeted an article about like a 1999 Barron's article titled Amazon.bomb that talked about the idea that Amazon was this, like selling $1 for 90 cents, that they didn't have a stable business model. And, at the time it seemed right because I think it topped at around like over $100 in 1999. And then it went down like 95%. To around like $5 or something. And I think at the time, like a lot of people believed that eBay was actually going to be dominating the e-commerce landscape. So I think today, like Amazon's worth like 40 or something times more than eBay. So definitely, like long-term investing is hard. Like how many shareholders predicted that all the way back from 1999, right? Like who would have predicted that Amazon would have been, one of the most powerful companies in the world? They would have not only been successful in e-commerce, but they would have also launched, AWS. So I think, like that all goes to say that even the best stocks go down at some point, right? Like you're never going to get a stock that goes up, up, up forever. However, it's also important to remember that most stocks actually don't recover. So you got to pick the right ones. And that's very hard. So like even for something like Roku, for example, like I'm sure like a lot of you know Roku. So Roku, like it IPO'd like over 4 years ago, and it's been a very successful stock since then. You have handily beat the market if you had owned it since the IPO. However, you have also had to endure around 60% drawdowns, including the current one. So each of those drawdowns, you had people screaming at you that the story was broken, that, like they were going to get crushed by Amazon, or that they would have been, like they're just hardware, they're just a stick. Like not talking about, the operating system, the ad platform. That would have been, pretty hard to have held. So you had to have conviction in your thesis. You had to have done the research. And, even mega caps like Facebook, Amazon, like people were talking about how Facebook was this like super solid company that you could just head to the beach and, like do nothing for 10 years and you have done fine. You have beat the market. But now look at what's happened. Like today it's down 25%, and people are talking about how TikTok's going to crush them. People are going to talk about how IDFA and Apple really sort of screwed up the model. So as a long-term investor, you have to weight that. Like I don't know if Facebook's going to recover, right? Like I think it's a quality company, but you have to figure out for yourself if this is a dip that's worth buying relative not only to just the quality company, but also relative to your opportunity costs. Like what other, like are there any better places for you to put your money today that will probably do better over the next 5 to 10 years? So I think it's important to like as a long-term investor, not just blindly buy and hold, but to buy and then constantly reevaluate, constantly keep up with the company, and to be able to separate signal from noise, and to really kind of understand what exactly would break your thesis, and be able to sort of react quickly when that happens.
Richard, this kind of takes me down the path of asking, like, obviously, the average investor, everyone knows that, like, FinTwit is a different place. I said this, these are the people who want to work and get that extra alpha in there. But it sounds like, hey, listen, you really should have those core broad-based indexes in your portfolio. Most people should have that as their entire portfolio is the real thing, and just dollar cost averaging that into that solely. But I want to kind of get your thought on that. Do you think that pretty much all portfolios, all long-term investing portfolios, should have a base of those indexes and ETFs in there? Just obviously the
Yeah, like
broad-based ones, not it's good to have the sector-specific ones, but I'm definitely talking about the SPYs, the QQQs of the world.
yeah, I think it depends on the situation. I think, like most investors, like when they start, maybe they should have like put sort of a larger percentage of their portfolio in these indexes, just because I think most investors they don't have the ability to beat the index. So if you're not willing to put down the work, do the research, and constantly keep up with your companies, then it's probably better to just buy and hold an index. But if you're willing to do the work, if you're willing to like put in the effort, and if you find that you're getting pretty good at it, then it makes sense to kind of hold a more concentrated portfolio of individual companies. I think that works for me. It's because if I were to hold like a portfolio of like 30 stocks, then I just wouldn't be able to keep up with all of them. At that point, it's just better for me to buy and hold an index. But I think, I've gotten to the point where I'm pretty comfortable with my own investing abilities. So that's why I don't hold the index. But for new investors, for sure, you should consider it.
How many stocks do you own about, and like where do you think your maximum, you know, how many do you think the most you could focus on at once, really as a long-term investor and be able to be the expert on it like you have to be? Where do you think that number is, and where do you how many stocks do you hold now?
So I think the maximum boundary would probably be around like 20, but that would be like uh probably like the upper level of my confidence. I own around under 10 stocks right now, so just about 10. And I feel like that is sort of the best area for me to be, where I can be confident in keeping up with my current companies, and always be on the lookout for new ones to add. But I have to compare, like whenever I come across a new idea, I have to compare it to kind of the weakest company in my own portfolio right now. So that's my opportunity cost, right?
Definitely. So you talked a little bit. I'll let us move it on. I won't keep harping on you and coming back to you. I'll let you breathe for a second, but definitely want to bring you back in as we cycle around a little bit. But yeah, you said you had 9, 10 stocks right now. Is there any one that maybe you're excited about buying more, buying more soon, dollar cost averaging into, or anything like that? Yeah, is there one you maybe want to highlight and talk us through briefly?
Yeah. So like I think my top two positions right now are GoodRx and Carvana. So I think like they're both pretty misunderstood companies, and I think that they both have sort of an unmatched value proposition for the consumer. So in terms of GoodRx, like why wouldn't you want to save like 80% off of your prescriptions? And I think GoodRx is able to have better prices than any other prescription discount app or platform, because they partner with multiple PBMs. So these are pharmacy benefit managers, and they provide good extra prices. And, like no one else has that kind of marketplace. And so I think, like they're seeing a lot of traction there, and pretty excited about their opportunity in pharma ads as well. So pharma wants to, advertise these kind of coupons and these sort of brands for their um, like kind of these highly priced branded drugs. And GoodRx is the best platform to reach the consumer because they have around like 6 million monthly active users. And so like I'm pretty excited about that. Like I think it's at a great valuation. With Carvana, it's also like they compete in the $800 billion used car market, and I think they have a better value proposition, both compared to how poor the traditional used car buying experience is, as well as other online players that aren't necessarily vertically integrated and can offer kind of the same prices and selection. So they really compete in terms of three factors, which is price, convenience, as well as selection. And I think that they are much better than the competition, and they continue to improve upon that. So I'm pretty excited about their prospects as well.
Perfect. Thank you, Richard. That's GoodRx. GoodRx. I say it weirdly as I'm trying to come in here after. GDRX and then Carvana, CVNA. We'll maybe dig a little bit more into those in the future. I know GoodRx is also a brand name. Thank you, Richard. Appreciate all that amazing insight. That was fantastic. Love hearing it. Definitely a very, very knowledgeable guy. So anybody in the crowd, we have about 400 people in here right now. Make sure you're following him. Everyone should be following Richard. Everyone should be following all of our speakers up here. big shout out to the Bullish Rippers account, which I'm on right now. We're trying to host some really top class and amazing spaces, and the people we have up here are the part of it. So make sure you're checking out those people. Thank you, Richard. Definitely want you to hang out up here. We'll have time to come back to you, cycle through some general questions, investing questions in general. But yeah, thank you, man, Richard.
Yeah,
thank you,
thanks.
man. And with that, I'm going to throw it over to Brad. Yeah, if you wanted to go a little bit into your stock deep dive, anything else you wanted to add with the situation that's going on right now?
Sure. Should I just go into Upstart, or maybe I could talk about Facebook earnings, or what do you think would be more interesting?
Let's do some surface level quickly on, Facebook and PayPal are two names, these two companies that a lot of long-term investors will be fans of, and they are huge companies and have gotten destroyed in the last couple of days. Facebook down 25%, that's trading like a penny stock when it's a trillion-dollar company. So I would love to maybe hear your quick thoughts on that area. We'll throw in another question in there on top of it, a selfish question. I have a bunch of stocks, you own a bunch of stocks, and they all seem to report in the same week. So also maybe kind of on top of that, how do you deal with that a little bit? Well, yeah, we'll start out with the Facebook PayPal earnings.
Yeah, and just kind of reiterating the praise for Richard a little bit. He definitely was part of helping me understand the immensely complicated pharmaceutical value chain for GoodRx. So definitely an awesome resource and a good friend, and happy to have gotten to know him on Twitter. But moving on to Facebook, I've owned. So this is my longest tenured holding, I guess. So I've held it since 2017, and since following the company, I haven't seen an earnings report this bad. Just to be candid and honest and open. The actual demand metric, the top line revenue was fine. Normally we see a pretty nice top line beat. They had a small currency headwind that they should have been able to overcome, that they really weren't able to. So sales pretty much in line, and then earnings well below expectations, which that's the first time in a very long time we've seen that for Facebook as well. And just some of the reasons that were highlighted on the call. Dave, or the CFO, the COO, and Mark, and the CEO Mark Zuckerberg, all three of them in the call multiple times mentioned more competition as one of the reasons for these lackluster results and the lackluster guide. Really not something I want to hear. But taking kind of the other side of that argument, Facebook has been very much so in this monopoly, or caught up in this monopoly and FTC drama, and so if they can kind of massage the messaging to make it seem like TikTok or maybe even Tinder or Pinterest, or sorry, Twitter or Pinterest. I'm sorry, my mind is on Tinder right now. I wonder why, but essentially, it sounded like they were trying to kind of dissuade this idea that they're a monopoly, and they aren't a monopoly. I mean, TikTok got to 1 billion users in the blink of an eye. It's hard to call them a monopoly with how many formidable competitors there are, but they're very much so a duopoly, and very powerful. But so that was one of the reasons. The other reasons they talked about is this transition of content for monetizing. So Reels is exploding on Instagram and Facebook, and that's great. It drives more traffic, but it's a much newer product, and it takes Facebook time to figure out how to most effectively monetize these products and these content forms, in terms of better, more meaningful ads that don't piss us off or annoy us, to get us to log off Facebook and go somewhere else. So they're actively figuring this out, toying with new ideas and new processes for monetizing all of the Reels content. And just I want to give a quote from Sheryl Sandberg to kind of level set expectations, and very high expectations I have for them being able to pull this off. So here's the quote. I want to emphasize that while we're going through a transition, we're optimistic. For those of you who don't know, Sheryl Sandberg is not normally a very optimistic person on these calls. We expect Reels monetization to improve over time and to close the gap. We've made successful transitions before, like from web to mobile and from feed to stories. We have a successful playbook here. So that is number two. And then number three, we were told last quarter that iOS, IDFA, privacy policy changes and targeting headwinds were peaking in the last quarter. That didn't really seem to come to fruition. They leaned heavily on for lack of a better term, the excuse that Apple is really is still weighing on both their conversions and the amount of data and impressions that they have access to, and also the fact that they're vastly underreporting web conversions to their marketers. So they're not really selling themselves and selling their value proposition as effectively as they should be able to at this point. They're investing heavily in artificial intelligence and data mining in their data science team to try and figure out how to sidestep this treasure chest of third-party data that they no longer have as easy and seamless access to. But they're still figuring it out, and these three growing pains are absolutely weighing. All three of them are absolutely weighing on the company right now. And we saw that with a Q2 or Q1 2022 revenue guide of a midpoint of 28 billion, and we were looking for 30.3. So an 8% haircut, not from Facebook, but from what analysts are expecting, is not something that we've been brought to expect from a company like this. They are a beat and raise machine, and they generally are a beat and raise machine, and then tell us how concerned they are about the future 3 months of the company, and then they beat and raise again, and tell us how worried they are again, and then they beat and raise again. So we've gotten really used to that cycle, and now it seems as though these headwinds that they've been warning us about are actually having a material impact on their business. And so I was a buyer when Facebook was dropping from its all-time highs to the low 300s like it was over the last few weeks. But like Richard was talking about, this idea that we have to continuously evaluate companies and how deserving they are of our capital and our time and our very finite attention that we have to focus on these companies. And this quarter didn't warrant, regardless of the 30% haircut that it's taking today, it doesn't warrant me accumulating more shares of the position. I want to say I'm not selling any shares. I'm not interested in selling a single share. But the broken stock and this large move, in my opinion, is somewhat warranted, because there's a lot of questions about the future execution of Facebook or of Meta that I didn't have before this. So of like how big of a piece of the overall pie is TikTok going to be able to take away from Facebook? How much of that screen time per day are they actually going to be able to take away? And executives sounded very concerned that it was going to be a large chunk. And yeah, you can say they're just saying that because they don't want to be seen as a monopoly by Capitol Hill, but that remains to be seen. Again, another idea that Richard was talking about that I deeply identify with. One bad quarter doesn't chase me out of a name. This was certainly a bad quarter, but it hasn't been the theme of bad quarters for Facebook or for Meta. Sorry, that's going to take me a while. But yeah, very underwhelming. Long-term thesis intact, a little bit more uncertain, and so really just sitting on my hands, sitting on the position, doing absolutely nothing right now, and just kind of waiting for more information across the tape on how the commerce rollout's going for shops, how Oculus content sales are going. But these growth projects are still very, very small pieces of the overall advertising Facebook revenue pie. And they're going to take a long time to become sizable pieces. So this cash cow that is ad impressions on Facebook and Instagram needs to last for a long time to support this massive spend in all these projects that they're focused on. And I think it will be able to. I'm somewhat confident that it will be able to, but I'm somewhat less confident than I was 36 hours ago. So that's really where I'm at for Facebook.
That was a great analysis there, honestly, man. I'm kind of in a similar place right now. The largest business, this is an advertising business. When you look at the other similar companies in that market cap range, they have, Amazon has its delivery business, but they have AWS and cloud, and all. It's a similar theme for all the businesses at the top. Apple has its iPhone businesses, but they have services and everything else around it. Facebook had the ad business, and for a while it was a cash cow. It was an amazing business, and it still probably is, but it's not what it was. And Brad, two comments I want to get you. One's more of a comment and one's more of a question coming back at you. First of all, I find it funny now, all this focus on the creator over the last couple of months from these platforms, Twitter, Snapchat, Facebook, whatever, maybe it's years. Like, it feels like this is why. They kind of knew there was going to be some struggle to the direct advertising revenue, and they're looking for those other ways. And as this was coming down the pipeline, creators and investing in that was kind of the concept there that they're going for. So I just find that more funny now that we're at this point and kind of hearing all the information on the table. And then one thing I did want to ask you about, you mentioned calling it Meta, which is very strange. And I kept saying, I'm not going to call this company anything but Facebook until they announce that ticker change, but they did. So I kind of want to ask you a little bit from your perspective at all. Does a ticker actually matter at all, or is it just kind of a nice marketing piece that's obviously good to have but won't really mean anything?
Yeah, definitely not a pressing part of the bull thesis. And I think irrelevant would be a good way to describe it for 99 out of 100 of these. But with all of this, with all of this negative press that Facebook gets, that I mean, you could theoretically see them distancing themselves somewhat from this brand being a small positive for them. And I want to emphasize the word small in that sentence because I don't think it's going to be a game changer or anything. But yeah, a lot of people don't have super positive feelings towards a lot of Facebook's practices, and I'm honestly one of those people for a few of the things that they do. But yeah, distancing themselves from a brand that has been kind of known as the Death Star in social media for a long time might be a positive for them, a small positive for them.
Yeah, I overall agree with that. Won't be the biggest thing. I think it's much more of advertising, people clicking into the Meta ticker, and the conversion over of people being able to be like, oh, this is Facebook or this is Meta or whatever with a Meta ticker. I think will be a little more, but that's definitely much more ancillary. Before we get into, I'm gonna come in one more question here, Brad, and then maybe we can go into the Upstart topics, and maybe with this, Richard, you want to come back in and answer after. It is really important that one quarter is not the business. One quarter is not how everything's going. There's anomalies, there everything like that. You have to be looking at the trend. And Richard, you even went back to say 2-3 quarters, which I definitely do agree with. But I kind of want to ask you guys, where do you start to get worried? Like, where's that point where, okay, it's a year now, it's 4 quarters or something like that? I know it's case by case and everything like that, but are there maybe any examples of you went from, okay, this was just one quarter, whatever, or this was just 2 quarters, to a point where, okay, this is not something I want to be a part of. I don't like this trend. I don't like whatever. I need to make a move with that. I would love to throw that over to you, Brad, if that was a well enough worded question.
For sure,
If
and
it
then
made
I'll
sense.
toss it over to Richard because I'm sure he'll have some more interesting stuff to talk about. And yeah, case by case is really the best way to put this. So, I mean, 2-3 quarters in a row of consistent underperformance probably will get me a lot closer to exiting than 1 quarter of underperformance. But at the same time, that 1 quarter of underperformance it's not binary outperform or underperform. There are definitely very specific degrees of underperformance, and if it's an aggressive enough degree of underperformance, 1 quarter can get me out of a company. And it's not just the headline numbers; it's how companies explain these headline numbers and the rationale they give behind the weakness. And it's kind of putting my thinking cap on and contemplating: do I think this makes sense? Do I think this is legitimate? Do I understand? Are there other competitors in the same space telling me similar things, or is this unique to the company? So maybe an example that I'll give super quick was Butterfly, which I was very excited about early in 2021 and exited later in 2021, just because of how absolutely putrid their last earnings report was. Like a 1,600 basis point gross profit margin guidance reduction, a 29% revenue miss, and then telling us extremely contradictory rationale for why it happened. Essentially saying their slowing growth is because we ramped up our enterprise sales team really fast, which they told us they were going to, which is why we were accepting these bloated net losses. And then so now they hired all these enterprise sales members. So shouldn't they be in a position to grow even more quickly instead of less quickly? And apparently not. So to me, it's really how they explain it, and then it's really the degree to which they disappointed. It's got to be really bad. It's got to be Butterfly bad. I'm sorry to pick on the company for me to get out after 1 quarter, but it is possible.
Yeah, and for me, I definitely agree with a lot of what Brad said. I think you have to look at kind of the trends within the sector and the reason why the company has underperformed. I think the company's management team, they're paid to be the company's best cheerleaders. So I think, like you should always take what they say with a grain of salt and kind of back it up with other data that you're also seeing. So for example, like I guess with kind of GoodRx, like over, since the IPO, I think their quarters haven't exactly been, like huge beat and raises. But I think kind of this year is kind of the year where I think that they should perform. Otherwise, like I think something's going to be, wrong with the thesis, and I should reconsider. Just because, like I think they have been severely impacted by kind of the drop in people going to in-person doctor's visits. And if you look at kind of the discount card competition, even though they're not public, like we have heard that they're also facing, similar headwinds, and they're also slowing down. And actually, GoodRx is taking market share at the same time. So because they're growing faster than their competitors. And so I think, this year management has said that they should return to baseline in terms of the prescription volume. So or the number of people going back to in-person doctor's visits. And I think that, like we should see that kind of boost. So if, like we're seeing things like continued slowdown in their prescriptions business, or, like they kind of like say like, or like give more excuses, like, it's going to be next year that this happens, then that's going to definitely raise some question marks. And I think, like these days on earnings calls, really every company, when they miss, they're trying to blame it on things like supply chain. With Roku, for example, like recently, they talked about how supply chain was a big headwind to their players business. And that was kind of understandable because, like in terms of the entire industry, I think, PV prices went up around 40%, and this caused a major drop in TV sales. And so Roku actually outgrew the industry in terms of that regard. And that was sort of understandable. However, going forward, I'd like to see kind of how they're tracking against the industry. And so that's important to keep an eye on. And I guess for Matterport, that was a company that really confused me when they talked about kind of how supply chain was really impacting their lower guidance. And sort of that was kind of a red flag. I mean, like I didn't own the company at the time, but if I had owned it, then that would have been a red flag for me.
You guys are sparking me too many good questions. The information is just rolling out there. So I guess we're going to keep rolling with it, Brad. I'll come back to you in a second. I actually want you to answer this question. But Richard, I would love to ask you, when you have a stock that you own, how deep do you dive into the competitors' research reports? So, whatever the company is, the biggest competitor, are you kind of doing it as if you full on own that stock in quotes and you have to know everything about it? Or is it a little bit more lax, kind of knowing generally how the entire competitive landscape is going? Or yeah, like how much are you digging into the top competitors of the stocks that you like?
Yeah, so if they're public, like I think I will try to do as much research as possible before I invest. I think for a lot of my companies, especially since they're earlier stage, a lot of their competitors are private. For like Roku, for example, like even though their main competitors are not private, Amazon doesn't exactly break out their Fire TV sales in their earnings reports. So I think, like that's kind of harder to track. However, there are, third-party resources like Conviva that just released their state of streaming report that tells you kind of how market share is changing within viewing time. So I think, like over this past quarter, or comparing like, Q4 to like Q4 2020, for Roku, they've actually gained a little market share in terms of viewing time, and Amazon Fire TV has lost some. However, other competitors like Samsung, LG TV, and Android TV are all gaining market share at a faster pace than Roku is. And so, even though they are, coming from a smaller base, that is kind of concerning. So I think that's definitely something to keep an eye on. I think, like like when you're doing your initial analysis, you should consider a company's moat. And so I typically like to invest in companies that not only have a strong moat today, but they are growing their moat. So they have some kind of network effect or economies of scale shared, where they're continuing to improve the value proposition relative to competitors over time. So that gap should widen. They should continue to gain more market share. And like you have like industries where there are like just huge tailwinds. Like I think the collaboration space is one of them. So like you see companies like Monday, Asana, they're all doing very well. However, like I couldn't get comfortable with them because I didn't really understand the moat of Monday, or like what really separates it. So I think for that one, like once kind of the entire space slows down, I'd have questions about how much share that Monday is able to retain. And that's why, like I wasn't able to invest in them.
That was fantastic. Thank you, Brad. You have any thoughts on the question? I kind of want to throw a little bit of a side question in there as well. When you're looking at these competitors, is it harder to kind of find in like a huge behemoth like Amazon what the Fire Stick is doing in there, or maybe is it a little bit harder when the company is private, when you have like very limited information about them. I wonder. I would think that the private company would be a little bit harder to get the research on than the hidden piece in the Amazon behemoth. But I don't know if you have any thoughts of that or have had any firsthand case with that. Or yeah.
Yeah, they both kind of present unique challenges. So Richard alluded to the mega cap challenge of of them not breaking out every single individual revenue line, because there would be hundreds of revenue lines if they were doing that. So so sticking with Roku, I don't know a ton about the company firsthand, but I think it's a good example with an Amazon or with a Google and their YouTube business. It's really tough to gauge kind of competitive outperformance for Roku versus one product within a massive suite of products. And then from the other on the opposite side of the spectrum, for these tiny private companies, sometimes we get press releases every now and then of, yeah, they did X amount of revenue in 2020, but we rarely have current information. We can kind of connect some of the dots using some traffic aggregators, or maybe an App Annie to be looking at downloads, or Similar Web to be looking at web traffic, to kind of piece together a few things. But it is tough to paint a complete picture of true competitive risk from both a small private company, which Richard and I kind of we don't have the same investment mentality, but we have a very similar investment mentality, and we generally invest in similar types of companies where like he said, the competitors and the competitive landscape is still mainly private. So that makes it tough. But yeah, to answer your other question, I want all the information that I could possibly have public access to. So if there are so for an Upstart, for example, so for a Pagaya, which is now going public via SPAC, that investor presentation, that SPAC investor presentation that I'm sure people are now rolling their eyes at every time they see, but it does serve as some good information. And then along those lines, Upstart in 2021, just with these massive, unbelievable beat and raises on the top and bottom line, then I would look at maybe a lending club to see, okay, how much of this is really just the consumer being on fire and consumer lending being on fire and stimulus kind of eroding default rates, and how much of this is unique to Upstart. So seeing that that the rates that the percentage of the raise that they've been making is larger than anyone else in the industry, that relative outperformance, the key term is relative, is something that I take very seriously. So those are the types of things that I'm looking for. I'll never have a complete picture of the competitive landscape, because half of it is private, and I'm not an accredited investor, and even when I am, I'll struggle to get access to 90% plus of the public or private market information that I want anyway. So yeah, I learn everything I can, and I accept the fact that I can't know everything, but I'll try and get as close to that as I possibly can.
Always digging for more information. I love it. I'm feeling the same way. It is important to be able to parse through that information. There is paralysis by overanalysis and getting all the thousands of different data points out there, but in general, having more information at your fingertips and being able to look through it and really gain opinions from it is only a good thing. So I do 100% agree there. I want to quickly reset and just let you know, I've said this once or twice up here, but big shout out to Richard and Brad for coming in here and just being a wealth of information, making this spaces so great so far. Make sure you're following both of them. Check them out. Click into their profiles. See what they're doing. Click that follow button. You will not regret it. Big shout out to my co-host, Wolf Financial, up here. He's putting on 20 spaces a week. It is ridiculous. We are super excited to be a part of it. Him and myself have been working together as hard as we can. He's doing the bulk of the work on the back end of it. I promise you, he's the space is king. If you were enjoying this session, you will enjoy following Wolf Financial. And with that, we've kind of gotten a roundabout way to get right back to what we prepared for you, Brad. I would love to hear your thoughts on Upstart. If your mic does cut out during this, which we know tends to kind of happen during this, we will pivot necessary.
Cool. And yeah, so I'm going to try and maybe keep this under 15 minutes, because I could talk about this company for hours. So maybe 15 is a good max. And
More
hopefully
Brad
under.
is not bad. So hey, whatever we got, we got.
Okay. All right. So Upstart, the loan augmenter for legacy banks. So I'm about to say a lot of really nice and exciting things about this company. Keep in mind a few things. It's a high risk, high reward type play. A lot left for it to prove. So far, so good, but long way to go. It's only 3-4% of my overall portfolio. So while I'm going to say a lot of really nice things, I still want to emphasize just position sizing is key, because of the third thing of I could always be wrong about any company that I love and choose. So just keep those three things in mind while I am about to say some really nice things about this company. So what is Upstart doing? So they're really trying to fix the antiquated underwriting system in the United States first, and then hopefully globally later. So what they're trying to address is the fact that there's 80% of Americans who have never defaulted on a loan, and yet 40% of Americans who have access to prime credit, so the best offers that a bank or a credit union can give us. Upstart likes to call this the hidden prime, and that 32% of the American borrower cohort is that's its target market. That's really what it's going after at this point in time. The problem with legacy underwriting, before kind of going into Upstart's fix, so banks and credit unions, they don't use only a FICO score, but they use generally 8 to 30 variables in what's called a FICO plus model, where FICO really drives the bulk of the risk calculation. And it's solely using a three, not solely, but it's predominantly using a 3-digit credit score to arrive at an approved rejected decision. This 3-digit credit score is based on 5 weighted variables. 50% of the weighting comes from things like payment history and length of credit history, that inherently discriminates against new immigrants and young borrowers. So we're left with a situation where essentially you have to be born into money to have early access to prime credit, which is a phenomenally wonderful economic enabler for so many people. And people without access to this, obviously, conversely, are precluded from a lot of these credit services that we need for economic mobility. So that's really where Upstart is trying to help. So the basics about Upstart, I'm going to go really quick here, because otherwise I'm going to talk for an hour. So they are not a bank. They're never going to be a bank. They don't want to be a bank. They don't originate their loans. They use bank partners and investors in capital markets and institutions to fund these loans. They don't target the 4 to 5 largest banks in the nation, but pretty much everyone else, because they're really trying to create an environment where they have this credit underwriting model where the extremely long tail of small banks and credit unions are all feeding their data into this credit model, along with the credit agency data that Upstart purchases to create a more predictive sense of risk. The market, I'm going to skip this section because just keep it. The market's massive. It could get a lot more massive if they successfully release products. That's a big if. But yeah, don't need to talk more about that. The first. So Upstart's product suite is a string of machine learning ML models. The first one is its credit underwriting model. Obviously, if you want to assess risk better, you have to underwrite better. So what this does is correlates 1,600 variables on a borrower. This includes things like data on transactions, macroeconomic signals, educational performance, a lot of things that in isolation aren't valuable at all, but when combined and turned into new variables. So think of, every lender does this. Think of debt to income, and we create a debt to income ratio. When you do this with alternative variables like Upstart's doing, you can create unique insights that uplift and improve this underwriting process. So 1,600 variables, you could question how important that 1,599th variable is. You'd be correct. No single variable is all that important in isolation. You can remove any of them, including the FICO score, and have that same level of predictability. It's really all these working in tandem in real time with immense scalability. That's what is pointing to this uplifted credit underwriting. And I'm going to skip ahead a little bit because I'm saying a lot of things about how good their credit underwriting is, and I'm not giving you any numbers to support that. So I'm going to skip to value proposition so I can actually quantify that improvement, because we have a lot of third-party data that's supporting what I'm saying. So from a consumer value proposition point of view, Upstart lowers APRs for consumers by 16% while raising approvals by a full 27%. This isn't from data sourced internally from Upstart. This is data from the Consumer Financial Protection Bureau, based on their own studies, This is not Upstart talking up its own book. This is a federal agency talking up Upstart with no financial incentive to do so. Skip ahead again. I want to say, when I finish this, I have an Upstart deep dive that's on my Substack. that's going to go way more into everything I'm talking about. So I'm skipping over a lot of stuff. But if you are interested in learning more, it's there, and I'll link it to the top of the spaces when I finish talking. But partner value proposition. So what I have to talk about what Upstart really is doing. They are sourcing demand for loans on their site, upstart.com, and then they are redirecting these loans either to their loan funding programs through an originating conduit, which is usually Cross River Bank, sometimes FinWise Bank, sometimes Customers Bank, or they are sending these loans to a bank partner like Apple Bank, who's actually retaining this loan on their balance sheet for net interest income. So partner value proposition. Loans. The loan business is extremely commoditized at this point in time. I think that's very safe to say. So what Upstart needs to do is be able to create larger loan books for companies, without sacrificing loss ratios, without raising default rates or impairment rates beyond a level that's palatable for these companies. So we have more data supporting that Upstart does just that. Its risk underwriting allows banks to juice their approvals by 2.7% without impacting loss rates. But the configurability of this risk underwriting algorithm is really what makes it so special. This 2.7x juice to approvals is not the only option for banks. They can tweak they can tweak approval rates. They can tweak their loss rates to kind of set how big they want their Upstart loan book to be and how much and what they want the return metrics to be like. And this is the power of using so much alternative data and all the legacy data that they also have access to create a more predictive sense of risk, which clearly they're doing based on all this data that I'm talking about, and based on the next point that I'm going to make from KBRA, the Kroll Bond Rating Agency, and their capital market value proposition. So Upstart leans heavily on capital market funding, and that's a product of its philosophy for growth. So think about going to a bank without any scale, without any data, without any proof, and saying, "Yeah, we underwrite better than you do, and we're better than you." So I think you can imagine banks and credit unions would be pretty hesitant to kind of embrace machine learning and alternative data and all these new things in their credit underwriting process when they have a FICO Plus model that's still churning out money, and when there's really no proof supporting what this young technology company is saying to central banks and credit unions. So instead of asking for hope and for support and for a leap of faith, what Upstart did was really lean on capital markets to fund all of these loans. So capital market participants, private equity firms, hedge funds, they have a unique ability to distribute and absorb risk that banks and credit unions simply cannot do as feasibly, as seamlessly. And they also are generally less regulated and less conservative institutions. So Upstart went fully ahead with this plan of leaning on Cross River Bank, which was its originating conduit partner, to source all of these loans, which it then bought back from Cross River Bank, which it then sold to Goldman Sachs and Jefferies to be through whole loan purchases. Sorry for the voice crack. To then be repackaged and tranched into tiers of risk via pass-through transactions or ABS transactions. A lot of terms there. They're all defined in the deep dive, but for sake of brevity, I don't want to go into every definition. But in terms of capital market value proposition, Upstart needs to be creating what's called residual cash flows for the ultimate holders of these loans in order for capital market demand to churn. So they need Cross River Bank to be making money. They need Jefferies and Goldman Sachs for sponsoring this and acting for some of the trust duties. They need them to profit from this. They need the investors in all of these loans to profit from Upstart loans. And in terms of these profits have to eclipse input costs, obviously, or this capital market demand train that Upstart has really leaned heavily on. It'll dry up, or Upstart's 5% take rate. That's just dividing platform and referral fees divided by its loan volume. It will go down because why? No one's doing this because they like Upstart or because they're friends with Dave Garrard. They're doing this because it's boosting their bottom line and it's a good business decision. And Kroll Bond Rating Agency is a free credit reporting agency that I monitor very closely. Their last surveillance report showed CNL, so cumulative net loss ratios, outperforming actual loss, or outperforming projected losses and trigger rates by an even larger margin. That's for every single one of Upstart securitizations, every single one of their pass-through securities. And we also have data during the pandemic about Upstart's spike in impairments being smaller than it was for pretty much every other loan competitor, and also their credit bands or their risk tiers being far more predictive of default and true consumer risk than legacy credit bands. They've also since had more people come out of what's called hardship programs, which is essentially forgiveness programs for loan payments. They've had more of their borrowers come out of those programs than the legacy consumer loan industry has as a whole as well. So a lot of outperformance amid COVID-19 just gave them a lot of proof points to go to banks and say, hey, you don't need to trust us anymore. We have all this data to support that we are doing a great job for our partners. But the key risk for Upstart is the fact that 2020 and 2021 was an extremely unique period of time. If you think about all this liquidity sloshing around institutional balance sheets, making them pressuring them to want to put these deposits to work and look for things like unsecured personal loans, which Upstart is sourcing to put these loans to work. We also have things, or to put their deposits to work, sorry. We also have things like stimulus checks that were going out constantly to American consumers. Upstart caters to lower credit or to non-traditionally credit-worthy borrowers. So you can imagine they relied on these stimulus checks even more than some of the other lenders. So of course, impairment rates and default rates were aided by all of these issues or by all these features of the macroeconomic backdrop at that time. And based on this, we have data that's starting to show that their delinquency rates are starting to creep up. It hasn't been aggressive, it hasn't been a consistent theme, but it has been a theme of rising delinquency rates in their most recent securitization transactions and pass-through transactions. Now, we have to keep in mind this is a product of a few things. So first is that changing macroeconomic backdrop. The CFO, Sanjay Datta, has already explicitly told us they are expecting rising rates of defaults, and they have priced that into their forward guidance. They're expecting, as the consumer normalizes, for Upstart to return to default rates that are consistent, quote, consistent with pre-COVID levels. And that word consistent is extremely important to me, because while Upstart was outperforming on a relative basis pre-pandemic, if they can get back to just outperforming by that margin when we get back to whatever the future macroeconomic backdrop is going to be in 2022 and beyond, they can continue to create these residual cash flows for all relevant parties. They can continue to grow their bank partner roster list, and they can continue to succeed. Now that, and then one of the other things that we have to keep in mind is that when bank partners and credit union partners are starting out with Upstart, they're generally doing so with extremely conservative risk parameters. They're doing so as kind of like a run of trial and error to see what kind of impact it has on their net interest margin. So as Upstart proves itself and as they show more proof points, sorry, I said the word proof twice in a sentence, but as they can continue showing more evidence that they're not just talking out of their ass, that they really do have this better means of quantifying risk, bank partners have been lowering their parameters and their restrictions. Some of them have even dropped the minimum FICO requirements they've had in place for 50 years. And as a result, Upstart is now sourcing more and more loans that are not AAA rated or AA rated, that are B or C rated. So of course, default rates are going to go up when this happens. And these lenders and these holders of residual cash flows are compensated with higher interest payments that makes these rising default rates okay. So a few other things I want to cover is regulatory traction. So when you're doing things like using alternative data and artificial intelligence and machine learning in the extremely regulated consumer lending space, that is inherently going to invite unwanted regulatory pressure. Encouragingly, and one of the reasons that I was so attracted to Upstart in the beginning is that they knew this. And at the very beginning of their journey in 2015, when they were originating the very first loan with solely using their own data, they were actively working with the Consumer Financial Protection Bureau, CFPB, to work towards what's called a no action letter, which was finally issued in 2017. Now, what this no action letter guarantees is that the CFPB and associated federal agencies have no present intent to sue or bring enforcement action upon Upstart pertaining to ECOA or the Equal Credit Opportunity Act. This letter expired in 2020 and was renewed again through 2023. No other online digital fintech consumer lending company has this same no action letter. And just some of the quotes that I have throughout this deep dive just clearly and concretely paints how big of a piece of the puzzle that was to risk teams for banks signing on with Upstart. Risks, talked about macro risk pretty extensively. concentration risk, when you're leaning on loan funding programs to shift loans to capital markets for funding, there's going to be a lot of concentration risk, especially when FinWise Bank and Cross River Bank are doing all this themselves. So the vast majority of their origination volume is through these two partners. That's not all that pressing of a concentration risk like we'd normally consider it to be, just because there are a lot of CRBs out there. There are a lot of FinWise banks out there that can step in these conduit roles, and that would happily do so if it was a good business decision again. But the other prong of concentration risk is Credit Karma. So Upstart sources a lot of its Upstart.com traffic from Credit Karma, or it had been in the past. And then Credit Karma got purchased by Intuit. Intuit's been making some hires within the consumer personal loan space or consumer personal loan. That was a little redundant, but anyway, that kind of hint at their ambition, their objective long term to maybe release some kind of product that is more overlapping between Credit Karma and Upstart than there currently is overlap. Now that concentration risk from 2019 to 2020 rose from 38 to 52%. That was a product of Upstart and Credit Karma continuing to run their operations, continuing to lend to consumers throughout the entire pandemic. And so you can imagine Upstart has 30 credit traffic partners. If 15 of them shut down and Credit Karma is still going full speed ahead, that will naturally lend itself to raising concentration. And since it peaked at 52% in 2020, it's since fallen back to the low 40s. So good news there. The other thing, last thing I want to talk about, and this is there's so much more I want to talk about, but I've been talking for so long, so I'm gonna make this the last point, I promise. So why does this point of who is actually funding the loan matter? So why do I personally care if capital markets are funding this and institutional investors are funding this, or if retaining banks are? And there's a few reasons. So first, banks and credit unions have access to lower cost of capital than do hedge funds trying to gain funding for these loan pools. This equates to passing some of those savings on to Upstart's consumers via lower APRs, lower annual percent rates. This fuels higher conversion. This fuels more growth. And banks and credit unions also generally feature more consistent consumer loan demand across macroeconomic environments, which makes credit shocks a little less daunting. They'll still be daunting for Upstart. They're relying on capital markets, but banks and credit unions can fix that a little bit. The other thing that I kind of alluded to earlier is that there's so many more pieces of the value chain commanding a chunk of the profits when capital markets are utilized. So you've got the originating bank, the institutional investor in the whole loan purchases, the institutional sponsor, so Jefferies or Goldman Sachs, creating the tranches for future sales to other investors. You've got the class A, B, and C investors in these pass-through and ABS transactions that all need to profit. And then the final residual holder of the final holder of the residual cash flows needs to profit. And then Upstart does. So I talked about how every single piece of the value chain needs to profit. It needs to profit with effective levels in order for this demand chain to hum. And that's much harder when you're passing loans through capital markets than when a bank partner is retaining the loan and just they need to profit and Upstart needs to profit. So we've got 5 third parties that must profit in order for Upstart's demand to continue churning when it's passed through capital markets. And we've got one other third party that needs to profit when it's not. Yeah, I think I'll leave it there because that was 20 minutes and I said 15 only. But thank you for linking that tweet to the top of the spaces. That is the Upstart deep dive. That's what I've been citing throughout this entire talk. If you're interested in learning more about the company, everything is there. And I don't say that lightly. I worked my tush off on this one, so yeah, give it a read if you're interested. And thank you for listening to my lecture.
Your TED Talk. Yeah, I'm here clapping. That was great. As always, as I said earlier, more Brad is good. So we're super excited about that. Like as Brad said, if you want to check out more of his in-depth thoughts on Upstart, they are linked in the nest above. Wow, Jesus, that was an interesting one. But yeah, so here we are. We're pretty much towards the end of this. I did have one or two more questions prepared, but we've gone for an hour. We got some really great topics in, some really great deep dives in, some great long-term investing talk in there. I want to head us around into wrap-ups. One more time, big shout out to Brad and Richard for coming on here and giving us such great content and information. Make sure you're giving them both a follow. Big shout out to Wolf. The space is king. Check him out. But Wolf, I would love to throw it over to you if you had anything you want to comment and any thoughts or whatever in general, and then would love to hear about, we do so many spaces together. There is no way any sane person could see 20 different spaces and know exactly when they're going to be. Give us the information on the amazing free product that we made to help people fix that.
Well, first off, I just want to give a big shout out to the Bullish Rippers account. It's pretty cool to see everything that we're doing there. For anyone who's unfamiliar, Stock Market News, Evan is currently on the Bullish Rippers account. I also do multiple spaces a week from that account. I'll be live tomorrow at 12. Every Monday we do Power Hour. And then next Wednesday, I think we have a pretty cool industry-specific one. So if you like spaces, but also really good tweets, the Bullish Rippers account is a great account to be checking out. Evan's tweeting from there. We're both doing spaces from there. And we've loved to see the growth. If you haven't already checked it out, the pinned tweet of the Bullish Rippers account is a giveaway that we're doing because we were able to hit 15K on there this Monday for Power Hour, I'm pretty sure. So let's keep things rolling with that. As for long-term investing, thank you, Richard. Thank you, Brad. It's great hearing from you. First time hearing from Richard for myself on spaces, but I've seen your content on my timeline plenty. So it was great to hear. I really liked how you went into the thesis and moat, as well as kind of giving your timeline and, what you're looking for from report to report. It was all really good stuff all around. So I loved it. I don't have too much else to add on the long-term investing besides that I may do, my best to scoop up some of these opportunities. There's, companies like Facebook, which Brad just talked about, that are trading at certainly a discount to, where they were just a few months ago. PayPal continuing to fall today. I think Shop as well, sitting at $8.19 now. So some really nice pricing just along here. So keeping my eye for opportunities. I think this space is a great one to not just hear about these opportunities, but also hear the deep dive behind them so that we can make the ultimate decision. To anybody that's in the crowd, please, if you were intrigued by this, definitely recommend checking out, of course, the speakers, but also going ahead and doing some research. If you want to figure out how to do research, I recommend just clicking into Brad's write-up up top and following his process. You'll clearly see it laid out inside of the article, and then you can emulate that, take those same type of ideas and processes and bring them over to other areas of finance. But appreciate you running this, Evan. That's all from me. Oh, and then yes, okay, the calendar, of course. How could I forget? We have the single best tool on Twitter for finding finance-related Twitter spaces. It's incredible. So if anybody clicks into my pinned tweet right now, you'll see we are indeed doing 20 spaces this week. No joke. 5 of them today, 3 tomorrow. We've already made our way through a dozen. How can people find all of our spaces? It is simple. We have one tool that you can use, and if you're not already on it, you need to join because over 3,000 people are using this every single day, and that is our Google Calendar. We built out a full-on Google Calendar that anyone can join. All you have to do to join it is DM myself right now or the other hosts up here, the Bullish Rippers account or Stock Market News. Just DM one of us and shoot us your Gmail. Preferably a Gmail. Works with other emails, but it's a Google Calendar, so it's built for Gmail. We'll add you on, and what that'll do is you'll get an email within 24 hours that will let you add our calendar to your personal calendar. Don't worry about it clogging it up. You can toggle it on and off very easy. There's no problems with that. But basically, this will allow you to see when every single space is happening, who's speaking on them, the timing, the topic, all that type stuff. And when the space is done, we'll grab the recording. You can see this is being recorded in the top left, and we'll put the recording in so you don't have to scroll through the timeline to try to find it. Again, 3,000 plus people using this on a daily basis. Hedge fund managers, stock traders, CEOs, NFT people, crypto people, we do it all. Whatever you need, you're in the right place. Even people who work at Twitter Spaces have DM'd us and asked to be on this. So with that being said, if you're not already on it, shoot me a DM right now, and I will get you on it ASAP. I see some DMs coming in. Good stuff. All right, back to you, Evan.
Perfect. Yeah, definitely.
Actually, last thing, make sure that you're following the Stock Market News account, the Wolf account, Bullish Rippers account, because once you see the event on your calendar and you come into Twitter, this will allow it to be at the top of your timeline. We always start ours on time.
Always on the dot. Appreciate that, Wolf. One of the best things that we've created. Make sure you're on it. Make sure you're checking out all our speakers. Send myself or the Wolf account a DM to get on that. All right, enough about that. I want to get us into wrap-ups. Richard, I'm going to throw it over to you first. Anything you want to leave us with, any comments in general? And I would definitely love to know more about how we can find more of the stuff you're doing. And is it just your timeline? Do you have any newsletters or anything you got coming up? Yeah, we'd love to hear anything we could do to support you and hear some really great information from you in the future.
Yeah, thanks for having me. So definitely, if you want, follow my Twitter feed, and I also have a Substack. So I'm going to try and get more write-ups out. I haven't been able to really have time for that recently, but definitely like get them out this year. And I also, work at Luca Capital and Saga Partners. So if you want, check out those sites as well. Link in my bio. But yeah, definitely happy to talk stocks if anyone has any questions about any of my holdings, and like always happy to hop on again in the future.
Perfect. Definitely will be texting you back, DMing you back to get back on here. Super excited. Some great information. Definitely a great follow as well. And everything that he is doing is in his profile, the Substack, the companies he works for, and hit that follow button. So definitely check out Richard. Thank you. Definitely will be circling back in the near future to get you back on here. Yeah, thank you for coming on. And I'll throw it over to Brad.
Yeah, nothing more for me. Sorry for hogging a lot of the talking time. Just want to reiterate, Richard does really great work. Wolf and Evan do really great work. So I think I just want to leave it there. You guys should say more nice things about yourself and less nice things about me. But thank you for having me. It's always fun. And yeah, have a great night, everyone.
It's a good relationship. We say nice things about each other because it's true. We come on, and the truth of it is, Brad, we're just really glad that we can be like-minded people coming together, wanting to share good information and really some good long-term investing thoughts. So I definitely think it's a great relationship. Love having you on here. As always, Brad's a regular on this space every single Thursday at noon. We go for about an hour and a half. Make sure you're following all the speakers up here. Big shout out to the Bullish Rippers account. Myself, I'm StockMarketNewz Evan, so I am hosting from this account. If you know me from there, I tweet from this account, as Wolf said. So we're doing a lot of big things over here. The next space from here will be tomorrow at noon. The next space in general, which if you're on the Google Spaces calendar, you already know, will be at 3 p.m. I'm fairly certain on that one. 3 p.m. today with Brian Shannon and Richard Moglin, hosted by Wolf Financial, and that will be an awesome space on technical analysis and markets and everything that's going on right now. Brian Shannon, the guy who invented VWAP, so if you're into trading, anything like that, you will definitely be into that spaces. Make sure you're checking that out. And we have another space coming at 5:30 today, talking about investing in real estate with Invest with Lex. So definitely make sure you're on both of those. Everyone, enjoy the rest of your trading day. Hopefully Facebook and everything from my fellow Facebook shareholders, hopefully it's up from here, but we'll see on that. Everyone have a good one, and thank you guys for joining in, guys and girls.
Take care.